Most traders lose because they trade against the market structure. They guess direction, they chase candles, and they wonder why they get stopped out. In this video, I'm going to show you how to read any chart with just 4 simple rules using market structure. Welcome back to Auto Markets. This is episode 2 of my Mastering Price Action series. If you're new here, subscribe now. I'm showing traders how to build their skills step by step. Built, not begged. Let's get into it. Market structure is the backbone of price action. It's how the market shows its intention. Every trending market is doing one of 2 things: making higher highs and higher lows, which is bullish, or making lower lows and lower highs, which is bearish. When structure breaks, that's when trends shift. Here's where most traders go wrong. They focus on one candle or one line. They ignore the bigger picture, but structure tells you whether to trade with the market or to stay out. Ready? Here are my 4 rules for reading market structure. Number 1, identify the trend. Are we making higher highs and higher lows, or are we making lower lows and lower highs? Number 2, mark the key highs and lows. Not every swing matters, only the major structure points, right? So then number 3 is wait for breaks of structure. When a key high or low breaks, structure is shifting. That's your signal to reassess. Number 4, trade with the structure, not against it. If structure is bullish, look for buys. If structure is bearish, then you know what to do. Look for sells. That's it. So here we're going to do a live example. Now we're using the USD CHF on the 5-minute chart. So if we go back to the 4 simple rules, the first one being identifying the trend. Are we looking for higher highs or higher lows, or are we looking for lower lows and lower highs? Now, as we can see, the market has gone up here, gone to its highest point and stopped. So that is a high. It's come down and it's created the next point of no return, and then that is the next lower high. So as you can see, we're making a high, a lower high, and here is the next one, a lower high again. We've then got a low, a lower low, a lower low again, and it just keeps on happening. And as you can see, that is the trend. Now, the second rule of this setup is marking the key highs and lows. So here we have 1, 2, doesn't really matter the size, I'm just doing it for reference point here, 3. So they're your higher lows. Here's your lower lows. Now remember, it says not every swing matters, only the major structure points. Now when it says the major structure points, it means the ones that, investing.com, good app to have. It means the ones that kind of make up the outside line. Now when I say that, let me just use a trend line just to kind of prove what I'm trying to say here. This area, yeah, this area here. So as you can see, yes, there are a few highs inside, but you just want the major ones. You don't want the ones that don't really touch and go that wide. You want the extreme ones, let's say. So that's what it means by only the major points. Then what you want to do is wait for break of structure. So in fact, what I'll do is I will delete them. I'll use a different one. So what we want to do is, when it says wait for break of structure would be it's coming down. Now we know the last high, lower high was here. The last lower low was here. So our next lower low needs to be higher than this, and our next higher high needs to be higher than this. So let's look. The next one is here. What does that mean? We've broke the lower low. It's now a lower high. Sorry, a higher low. I'm getting confused. It's now a higher low because it's higher than the previous low. This one is lower than the next one. So that is now a higher high. And it continues. So as you can see, we don't really have much of a structure to show a low here. So I'm just going to go with this one for the time being because this candle hasn't finished. So as you can see, we have a higher high again. Now, if you really want, we could use this one. Either way, it's still a higher low. I'm trying to get the right word out. So as you can see, the structure has changed. It's gone from lower highs and lower lows to higher highs and higher lows. This is what you're looking for. Now it says trade with the structure. This is the fourth one, not against it. So if the structure is bullish, you're only looking for buys. So on this way, you should have been looking for sells, just pure sells. Ideally, when structure hit these major points here, that's when you should have been trying to jump in for a sell. Then once the structure broke, you'd be looking for higher highs and buys. So when you're at the bottom of it here, obviously you wouldn't know at the first one, but when you got to here now you want to be looking for buys. There you go. Here's another one that you could have taken up to the next structure point, or you could stay in even until it just changes structure again. And this is how you know which way to be going, whether it's high or low, buy or sell, long or short. I hope this has helped. Prop firms love structure-based traders. They're consistent, they're patient, they don't force trades in chop or reversals. If you want to stay funded, master market structure first. Everything else builds onto it. So what's next in the series? In the next episode, I'll show you how to draw support and resistance zones the right way, and how to combine them with market structure for sniper entries. If this helped you, drop a like, subscribe, and share this with another trader. Grab your free price action roadmap and join our Auto Markets community for daily lessons. We're built, not begged. I'll see you in the next one.